Did you guys know that someone actually paid $19 million last year just to have lunch with Warren Buffett? That's right, $19 million US dollars. But he didn't just go for the steak. He went to hear his secrets on making money. Now, we all can't drop millions to have lunch with him and learn his financial secrets, but don't worry, I've got you covered. Warren's life is probably the most fascinating financial success story of our time, and I'd recommend reading The Snowball, Warren Buffett and the Business of Life by Alice Schroeder. If you're tired of feeling stuck with your finances and want some pro tips to get ahead, you'll want to watch this video till the end. Trust me, watching this video could be the most valuable time you ever spend. So let's jump right in with the first golden nugget from Warren Buffett. Number 1. Never lose money. Even Buffett lost about $25 billion back in 2008. So what's he really talking about? You see, he's not saying you'll never lose a dime. Nobody's perfect. But what he means is go into each investment like a detective. Do your research, know what you're getting into, and don't just gamble your money away. It's all about the mindset. Buffett doesn't just throw his money into some hot stock because everyone else is doing it. Nope, he studies the companies like he's studying for the biggest exam of his life. So remember, never lose money doesn't mean never have a losing trade. It means be smart, be prepared, and don't let your emotions make your decisions for you. Number 2. If the business does well, the stock eventually follows. Warren Buffett is telling you to focus on the actual company, not just its stock price. Ask yourself, is this a solid business? Is it making good money? If the answer is yes, the stock will likely go up over time. And before you buy any stock, jot down why you think it's a good investment at that price. It helps you think clearly and could save you from making a mistake. So remember, invest in good businesses and the stock will usually follow. Number 3. Always have a margin of safety. This one's a little like having a safety net under your tightrope. In simple words, it means try to buy a stock when it's priced lower than what it's really worth. Why? Because it gives you a cushion. If things go south, you have less room to fall and lose money. Buffett gives a great example. Imagine you're driving a heavy truck over a bridge with a weight limit. If that bridge is just a small gap, you might risk it. But if that bridge is over the Grand Canyon, you'd want a lot of extra weight capacity, right? That extra capacity is your margin of safety. Number 4. Find companies with good earnings. Buffett likes companies that make good money consistently. We're talking about a strong track record of growing profits, usually over 5 to 10 years. He doesn't get caught up in the short-term ups and downs that come every quarter. Some people freak out if a company doesn't hit its quarterly targets. Buffett doesn't. He's playing the long game, and you should too. Number 5. Look for a consistently high return on equity, or ROE for short. Now, ROE is like a report card for a company. It tells you how well the company is using the money investors put in to make even more money. The higher the ROE, the better they're doing. Buffett says to pay attention to this, not just the earnings per share you often hear about. Why? Because ROE gives you a bigger picture of how well the company is actually being run. It's about quality, not just quick profits. So ROE is the indicator you need to make a smarter investment choice. Number 6. Does the company earn a high return on capital? This is like ROE's big sibling and covers both debt and equity. Basically, it's a measure of how good the company is at turning the money it's borrowed or raised into more money. You'll often hear this called ROIC, or Return on Invested Capital. A high ROIC is a good sign because it means the company is using its money wisely, not just piling on debt. Why does this matter? Companies that rely too much on debt can struggle, especially when times get tough. So, ROIC can give you a good sense of how stable a company really is. The formula may look complicated, but it's worth looking into. It can really help you separate the winners from the rest. Number 7. Is the company conservatively financed? This is basically asking, is the company being smart with its money? Too much debt can be like a quicksand for a company. If business slows down or the economy takes a hit, that debt can pull a company under, fast. The debt-to-equity ratio is a good way to check this. A ratio of no more than 1.5 is a good rule of thumb. But Warren Buffett goes beyond that. He says, forget just looking at the numbers. Ask yourself, Can this company pay off its long-term debt with its earnings in a reasonable time? There's a useful number you can look at called the solvency ratio. This shows whether a company is generating enough cash to stay afloat. Anything above 20% is a thumbs up. Number 8. Does the company earn more money than bonds? Imagine you have two options, investing in a company's stock or buying a U.S. Treasury bond. You'd want the stock to give you a better return than the bond, right? Warren Buffett compares a company's return on equity, ROE, with the yield on a bond. If the ROE is higher, that's a sign that the company is doing a better job at generating profits, and it's probably a better bet for your money. A quick way to check this is by looking at something called earnings yield. It's a simple formula that compares a company's earnings to its stock price. If this yield is higher than what you'd get from a treasury bond, then the stock is likely a good investment. Number 9. Does the company have an economic moat? An economic moat is like an invisible force field around a business. It makes it tough for other companies to compete with them. Think of brands you can't live without or companies that offer something no one else can. That's their moat. It could be anything from cutting-edge technology, patents, strong brand recognition, or even just being the only game in town. Why does this matter? Because a company with a solid moat is likely to keep making money, and that means it's more likely to be a good investment for you. Number 10. Circle of competence. If you don't get what a company is selling, how can you judge if it's any good or not? Warren only invests in businesses he understands inside and out. If it's too complicated or out of his expertise, he skips it. And if the Oracle of Omaha is doing it, maybe you should too, right? So before you dive into a stock, ask yourself, do I really get what this company does? Could I explain it to a friend or a family member? If the answer is no, then maybe it's not the best fit for your portfolio. Number 11. Avoid companies that might be obsolete in 20 years. Warren Buffett has a sixth sense for avoiding businesses that are like shooting stars, bright today, gone tomorrow. Buffett suggests looking for companies that you're confident will stand the test of time. Ask yourself, is this the best bet for your hard-earned cash? He's got this saying, time is the friend of the wonderful company, the enemy of the mediocre. So do your future self a favor. Invest in companies that you think will stick around for the long haul. It might just save you from investing in the next big flop. Number 12. Diversification. Buffett is not a fan of companies that act like they're playing darts in the dark, throwing money into ventures they don't understand. It's basically when a company starts branching out into areas where they have zero expertise. He's got this saying, diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. Now that's some food for thought. So if a company's taking on projects or markets that are way out of its league, it might be a red flag. Stick to businesses that focus on doing what they're good at. Number 13. Raising prices with inflation. If a company is stuck in a price war or has a ton of competitors breathing down its neck, it may not have the freedom to raise its prices when inflation hits. Inflation is like that annoying guest who shows up uninvited but always seems to come around sooner or later. So when you're scouting for companies, check if they have the wiggle room to hike up prices when inflation rears its ugly head. If they can't, you might be looking at some flat earnings and even potential losses down the road. That's not what we want, is it? So pay attention to a company's pricing power. It can be a game changer during inflationary times. Number 14. Capital expenditures. It's a term for the big pricey things a company needs to buy to keep growing or even just to keep the lights on, like new machinery, technology upgrades, or even a brand new factory. Warren Buffett always asks, are large capital expenditures ahead? If a company needs to drop a ton of cash soon, it might have to cut back on other things, like paying dividends to shareholders. Especially if you're looking at industries that require big investments. Think car manufacturing or telecom. You should be extra vigilant. Those big ticket items could affect your investment's profitability down the line. Number 15. Be fearful when others are greedy, and greedy when others are fearful. You know how people go bananas over the latest hot stock? That's when you should be cautious, fearful even. When everyone is rushing in, prices can skyrocket, and you could end up buying at the top. Nobody wants to be that person, trust me. On the flip side, when the market's having a meltdown and folks are selling like there's no tomorrow, that's your cue. This is when some quality stocks, good companies with strong numbers, get dragged down too. It's like a sale at your favorite store, but for stocks. Buffett's mantra is all about not following the herd. Keep a cool head, do your homework, and look for those margin of safety opportunities. When people are freaking out and selling, you might find some real gems at bargain prices. Number 16. Share buybacks. This is when a company buys its own shares from the market. Why is that a big deal? Well, it's like someone buying their own merchandise at an auction because they believe it's worth way more than people are bidding. Warren Buffett loves this. When a company is buying back shares, it could usually mean three things. First, the bigwigs at the company believe their stock is undervalued. They think the market is basically having a sale on their shares. Second, it shows that the company has enough cash lying around to invest in itself. Or third, they have some big plans on the horizon, which could send the price of their stock shooting up. This is a good sign for you. It suggests that the company not only has a strong financial footing, but also believes in its future. Number 17. Keep it simple principle. Warren Buffett is on the lookout for businesses so easy to understand that anyone can run them. Why is simplicity such a big deal? Imagine a business that's as complicated as a Rube Goldberg machine with all sorts of levers, pulleys, and whatnot. It might be cool to watch, but what happens if one little piece goes off track? The whole thing could collapse, right? Now what if the management team isn't up to par? A complicated business requires a genius at the helm, and geniuses are hard to come by. But a simple business doesn't need a rocket scientist to run it. It's like having training wheels on a bike. You can still move forward even if you're a bit wobbly. Buffett even cracks a joke about this. He says you should invest in a business so wonderful that an idiot can run it. Number 18. Long-term investing. Rome wasn't built in a day, and neither is wealth. Buffett knows this, and he's pretty vocal about his favorite holding period being forever. When Buffett looks at a company, he's not looking for a quick buck. He's sizing it up for the long haul, asking questions like, will this business still be around in 30 years? Does it have a sustainable competitive advantage? Can it weather economic downturns? Now, why does he harp on the long term? Well, he knows that the stock market is essentially bipolar. In the short term, prices go up and down based on investor sentiment rather than the company's actual value. But over the long term, that volatility smooths out. Number 19. The best time to sell is never. This principle captures the essence of long-term investing. However, this doesn't mean you should never sell under any circumstances. Rather, it underscores the importance of committing to investments for the long haul when their fundamentals are solid and they are likely to grow in value over time. This approach reduces the impact of market volatility and provides the opportunity for compounded returns. Buffett's perspective stands in contrast to active trading strategies, which often entail frequent buying and selling based on short-term market movements or speculation. Such strategies are not only risky but also incur more transaction costs, thereby reducing net returns. Number 20. Buy bargains. Buffett emphasizes not just the purchase of valuable assets, but acquiring them at prices below their intrinsic value. This often happens during times of market panic, recession, or extreme pessimism. Buffett's strategy is often contrarian in nature. While the market is driven by a herd mentality that results in overreactions, Buffett sees these times as golden opportunities to buy. The art of buying bargains isn't about impulsive buying during a market dip. It requires disciplined financial analysis to identify fundamentally strong companies that are undervalued. Additionally, timing is crucial. As Buffett aptly puts it, no matter how great the talent or efforts, some things just take time. Once a bargain is bought, the idea is to hold it for the long term. This is where Buffett's philosophy of our favorite holding period is forever comes into play. Check out this video if you want to know how you can take advantage of a recession and the best things to invest in.